This module equips you with comprehensive knowledge of financing options, risk management strategies, and insurance mechanisms involved in the exportation of agricultural products. The objective is to help exporters access appropriate funding, safeguard against trade risks, and maintain sustainable international trade operations. Export financing refers to the financial support provided to exporters to enable them to execute international trade transactions. In agricultural exports, where large capital and delayed payments are common, financing is crucial to support working capital, pre-shipment needs, and post-shipment activities. Major types of export financing. We will be using type, description, and typical use case in our table. 1. Pre-shipment financing. Funds provided before goods are shipped. Raw material purchase, packaging, processing. 2. Post-shipment financing. Funds after goods are shipped, but before payment is received. Bridge cash flow gap due to delayed payment. 3. Export credit. Short-term credit facilities from banks or export credit agencies. Facilitates goods delivery on credit. 4. Factoring. Selling export invoices to a third party at a discount. Ensures quick liquidity. 5. Forfaiting. Selling medium-term receivables for a lump sum. Used for high-value, long-tenure deals. Institutions that provide export financing. Commercial banks, e.g., Zenith, UBA, Access. Offer export working capital loans. Export-import, EXIM banks, specialized export financing. Export credit agencies, e.g., Nexim Bank Nigeria. Provide loans, guarantees, and insurance. Development banks, e.g., AFDB, BOA. Target agri-export projects. International donors, e.g., USAID, ITC. Offer grants or blended finance. Export risks in agricultural trade. Agricultural export is risky due to perishability, market volatility, political instability, and international compliance demands. Understanding and mitigating these risks is essential. Major risks include: we will be using risk category, description, and examples in a table. First, commercial risk, risk of buyer non-payment or delayed payment, default, insolvency, refusal to pay. Second, political risk, instability in buyer's country, sanctions, war, changes in government. Third, currency risk, exchange rate fluctuations, Naira losing value after agreement. Fourth, transportation risk, loss or damage in transit, spoilage, theft, shipment delays. Fifth, regulatory risk, change in trade laws or customs requirements, import bans, documentation rejections. 6. Production risk, losses from pests, drought, or input shortage, underdelivery or contract breach. Export credit insurance and trade insurance. To protect against some of these risks, exporters must take up insurance cover tailored for international trade. Export credit insurance covers non-payment by foreign buyers due to commercial or political reasons. Providers: Nexim, ECIC, Lloyd's of London, Euler Hermes, Africa Trade Insurance Agency, ATI. Marine cargo insurance covers loss or damage to goods during sea-air-land transit, mandatory for exports through ports or international air cargo. Currency risk insurance, forward contracts and options to lock exchange rates. Prevents financial loss due to forex market volatility. Hedging and risk mitigation strategies. Hedging refers to financial mechanisms used to protect against price or currency risks. Common risk mitigation strategies. Letters of credit, LC. Bank guarantees payment upon delivery. Advance payment. Buyer pays a portion up front. Incoterms, e.g., FOB, CIF. Clarifies delivery, cost, and risk responsibilities. Export contracts, legally binding with penalty clauses. Quality control systems, reduces rejections or losses in destination markets. Currency hedging tools. Forward exchange contracts. Currency swaps. Options. Contracts. Exporters working with volatile currencies, e.g., Euro, USD, can use these tools to fix their earnings and protect profit margins. Key export support institutions in Africa. Nexim Bank, Nigeria Export-Import Bank, offers the Export Development Facility, EDF, Export Credit Guarantee, and Trade Insurance, works with CBN to disperse export stimulation funds. Afrexim Bank, African Export-Import Bank, provides large-scale export project loans, runs programs like the Intra-African Trade Fair and AFTRAF. African Trade Insurance Agency, ATI, provides political risk insurance and investment guarantees. NEPC, Nigerian Export Promotion Council, facilitates trade fairs, export training, and market intelligence. Managing credit and payment terms in agri-export. Agri-exporters must set clear payment terms to reduce uncertainty. Popular payment methods include: we will be using method, risk to exporter, and description in our table. 1. Advance payment, low, full or partial payment before shipment. Second letter of credit, LC, very low. Bank assumes risk and ensures payment. Third, documentary collection. Medium, documents released upon buyer payment. 4. Open account. High, goods delivered before payment. Note: for new buyers or first-time markets, avoid open account without insurance. Practical steps for financing and risk management. Register with local export promotion agencies. Establish relationships with multiple financing sources. Conduct credit checks on foreign buyers. Always insure shipments, especially perishable goods. Use hedging tools to manage exchange risk. Stay informed on global trade and economic news. Maintain a legal advisor familiar with trade law.